Dear dividend investors, what if I told you that the Schwab US Dividend Equity ETF, SCHD, one of the most popular dividend growth ETFs out there, is a complete and utter joke that is going to massively underperform a total market index in the future? Well, I'd be telling you the truth. Welcome back, everybody. We got to talk about why this ETF that is it's so popular amongst dividend shills is absolute, actively managed garbage. Now, you may look at me and say, Chris, this is not an actively managed ETF. Look at the name of the index that it tracks, you absolute fool. It seeks to track as closely as possible the Dow Jones US Dividend 100 Index. It's an index, right, Christopher? That's where you're wrong. Now, when we think about the essence of index investing, true index investing is buying every company in the market at market cap weights. In indexing, you're saying you don't want to make active decisions about buying stocks. Instead, you're going to passively own the entire market and let all of the market's participants do all the price discovery for you. And that helps you avoid all sorts of additional risks that come with active management. Now, people will say, yeah, that makes sense. But then they'll say, well, once again, the Dow Jones US Dividend 100 Index is an index. But it's not a true index. Compare what we're about to look at. This index, this Dow US Dividend 100 ETF index or whatever. Let's compare that to what I just described as a total market index where you're not making any active decisions about the securities that you're buying. So if we go and we look at the US Dividend 100 Index itself, the index universe is defined as the constituents of the Dow Jones US Broad Market Index, excluding REITs. So right off the bat, the first thing that I read is, okay, we're excluding real estate investment trusts. Why? I thought an index was just buying everything because you don't know, you're not making any active decisions. But there has been an active decision to exclude real estate investment trusts from this Dividend 100 index. On top of that, stocks in the index must pass the following screens: 10 consecutive years of dividend payments. How is that a passive choice? It's not. It's active management. You're actively selecting stocks that pay dividends. Well, I can tell you there's great companies that pay dividends. And I can tell you there's absolutely clownish companies that pay dividends. But just the fact that it pays a dividend, why is that a factor? Why is that being brought in? A dividend isn't the end all be all. It's just something that a company does to distribute some of its cash to the shareholders and reduces the value of the company in proportion to the dividend paid. Why? It's active management, okay? Minimum, I think, float adjusted market capitalization of $500 million. So apparently, we're going to exclude any companies that have a market capitalization under $500 million. Why? Are there potentially some amazing companies that have a market cap under $500 million? Yes, but you're actively choosing to exclude those, okay? And then finally, we have minimum 3 months of active daily volume of trading, active daily trading volume of US $2 million. So right off the bat, we have 3 specific criteria, really 4, that indicate this is an actively managed fund. On top of that, we have additional stuff. They're ranked by 4 fundamental base characteristics: free cash flow to total debt, annual net cash flow from operating activities divided by total debt. Companies with zero total debt are ranked first. So we are actively screening for companies that have better cash flow to debt ratios. Could be a good thing, but it's an active decision. Return on equity, annual net income divided by total shareholders' equity. The higher the past return on equity, the more weighting we're going to give it to it, right? IAD yield. Actually not sure what that means. And 5-year dividend growth rate defined as, So we're selecting for all of these different factors, okay? This is a joke of an index. This is a fake index. This is a clownish index. Either you index or you don't. And just as more proof for the pudding, okay? Schwab, the SCHD, periodically rebalances. They periodically change their top holdings. And we can see on the Seeking Alpha article that they've added a bunch of stocks. They added 25 securities. AbbVie, Chevron, UPS, Blackstone, Ford, and then they've deleted a bunch of securities. Now, this wouldn't be, because like every index does this. Even a total market index is going to take off companies that have gone bankrupt and add companies that are added to the index. But that's factoring in all of the investable market. Okay, of course, new companies are going to come in. This ETF has like what, 100 stocks? 110 stocks at the most? It has nothing. Okay? You cannot compare this to a total market index. You're selectively buying a very narrow band of stocks in the stock market, which to me is absolutely idiotic, because just because you don't have a dividend doesn't mean you're a good company or a bad company. Not in the slightest. Now, people will point to past performance, and this is where people just like, they lose me, okay? Because they seriously think that past performance is how you buy an index. That's it. You just look at the past performance, and whatever went up the most, you buy it. It's as simple as that, right? Wrong. It generally, stuff that has outperformed in the past will probably revert to the mean and actually underperform in the future. Go look at ARK, okay? The Cathie Wood ETF. Did absolutely fantastic. And if you had bought ARK because it went up a lot, guess what? You would have lost a lot of money, okay? It's the same thing with SCHD. So you have basically 100 stocks that are all very selectively picked, and they're all U.S. stocks. So you have 100 stocks in one country. And you're buying it because of dividends, which are absolutely meaningless. They do nothing. The stock price goes down by the amount of the dividend. Okay? What's the point of this? Can somebody explain to me how this is an index? And we know that indexing wins most of the time. Indexing always wins in the long run. Actively managed funds underperform. This is an actively managed fund. It is an index that is trying to hide the fact that it's actually actively managed. It's a joke, okay? So I'm not a big fan of this. And the people that buy this, they also buy VOO, and they just buy a bunch of stuff that makes it all overlap. It doesn't make any sense, okay? But hey, it's got a low expense ratio. It went up a lot, so I guess it's a good ETF, right? All right, that's kind of my thoughts. I'm not a fan of this ETF. Let me know your thoughts. I mean, obviously, a lot of you shills own it, and you get those dividend distributions, and they feel so good until they go in your tax form. But hey, whatever. Talk to you later.